Good afternoon, everyone. Thank you for joining us today during your precious lunchtime for Endowus second quarter market insights and performance review webinar. And we will also have a forward-looking session on, how the market will pan out in the second half of this year. And my name is Yuling, investment lead at Endowus. With me here is Kyung-Ju, one of our investment associates. So before we get into the main section of today, we need to go through some compliance disclaimers. Next slide, please. Great. So we're also taking questions today during the webinar. Please go to this link that you see on the screen and type the keyword Endowus H2 to access. You can also scan the QR code. You can put in any questions that you want to ask during the session or even during the Q&A session. Next slide. A lot of people tuning in today are already familiar with us, but I understand that some of you are new to Endowus. So here is a really short introduction about us. We are a digital wealth platform. Our mission is to give great conflict-free advice that will help you to invest better, to live better. And that means, for example, we don't earn on commissions and offer our services at affordable prices while rebating trailer fees back to our clients as 100% cash back. The investment office, which we are a part of, works with world-class fund managers to give institutional quality and access to share classes that were only available to big institutional investors like the GICs of the world. But now they're available to investors like you and me. And we are backed by some of the most well-known and respected wealth and tech companies in the world. And going into the next slide, just wanted to highlight also on the right-hand side, we have also won multiple industry recognitions as an independent fee-only wealth platform. So moving on, today we will bring us through a broad market review first with a focus on the second quarter of 2024 before going into the market outlook section and portfolio reviews. In the second quarter, global equities delivered strong positive returns, continuing its strength in Q1. It experienced some pullback in April, as you can see on the dip of the blue line on top, but then it resumed its rally in May and June. On a one-year basis, global equities market has experienced a really strong performance year to date. On a one-year basis. And the global fixed income market had a relatively muted quarter. Duration exposure was generally negative, while credit exposure was positive. Again, on a one-year basis, the overall global fixed income market was up. The commodities market had a slight positive return in the second quarter, and particularly looking into the subsectors, industrial metals and precious metals were the best performing segments of the commodities market in the index, while agriculture was the weakest. Gold had a really strong quarter, returning about 5%. Moving on to have a closer look at the Federal Reserve's next move on monetary policy as the financial market continues to keep a really close eye on what's happening in that space. However, as you can see, the narratives kept changing alongside with new economic data release. For example, in December, the market was anticipating 6 rate cuts in 2024, and this has since been pared down, and following the FOMC meeting in June, Fed signaled only 1 cut at the end of the year. However, the latest US CPI inflation release in July offered encouraging progress in lowering inflation. Market is now pricing almost 100% probability of a September rate cut by the Fed. And moving on to the next slide. So what it means for the fixed income market is that rate volatility continues and will continue. The chart is quite busy, but let's just focus on the ups and downs. The 3 lines plot the 2 years, 5-year, and 10-year US Treasury yields. and they have gone through much twists and turns in the past 1.5 years, reacting to new surprises. And in Q2 that just ended, US yields increased first before coming down, ending the month slightly higher. This means duration exposure in the US hurt in Q2 as mentioned before. And the yield started to come down more in July. And as of last Wednesday, 2-year yield was around 4.4%, followed by 5-year at about 4.08% and 10-year at 4.16%. It's important to note that these are still at very elevated levels, historically speaking. Moving on to the next slide, that was the overall rate picture. Now let's turn into the performance for the different fixed income subsectors. We saw quite a bit of divergence between regions and sectors year to date. And one key takeaway is that there is increasing divergence in the growth and inflation trajectory between the US and the other countries. So keeping a diversified global fixed income portfolio is crucial. And in the first half of 2024, risk assets such as high yield credit, Asian credit, and emerging market bonds gained and claimed the leadership position. Hopes for a soft landing and high investor demand continued to tighten the credit spread, which helped the performance of these sectors. On the other hand, as alluded to before, government bonds, which generally have quite a bit of duration exposure, detracted. And this is not only true in the US, but also in Europe, for example, with the European government bonds underperforming the US in the first half. Now turning over to Kyungju to cover the equity market performance.
Thank you, Yulin. So for equities, the first half of 2024 was a period where returns were again dominated by US equities, and in particular, the Magnificent Seven technology stocks. So as you can see in the first chart, US equities really led the pack from January to June 2024, outperforming global equities. When we dissect these US equity returns in the second chart, you can see that US equities without Mag 7, as shown in blue, wasn't all that great. It was really the Mag 7 companies that drove the stellar returns of the US equities market once again, just like what we've seen since last year, largely running on the back of the AI wave. And if you look at the next slide, it wouldn't be surprising to see that on a sector basis as well, much of the US equity returns were driven by tech and communication sectors, each posting more than 20% of gains. Still, you can see that many of these other equity sectors also did pretty well, with most of them posting positive returns in the first half of 2024. So all in all, it was a generally positive first half of the year for equity investors. Back to you, Yulin.
Thank you, KJ. So now we will take a quick look at how Endowus portfolios have performed for the second quarter and also the first half of 2024. I will go through the flagship portfolios first, and then moving on to KJ to cover the rest of the portfolios. So the flagship cash and SRS portfolio continued to deliver positive returns in the second quarter of 2024, but it did underperform the broad global equity markets by a slight margin. The fixed income portfolio had slight negative returns in Q2, but still managed to outpace the broad fixed income markets. So the 100% equities portfolio has structural tilts to factors such as value and small caps via the dimensional funds, and these factor biases detracted from relative performance as value underperformed growth in the US and small cap lagged their larger peers. And the 100% fixed income portfolio's outperformance compared to the benchmark during the second quarter was primarily because of its higher allocation to the emerging markets bonds compared to the index. High yield bonds, which the portfolio also had exposure to, also demonstrated outperformance compared to the government bond exposure. And next slide, looking at the flagship CPF portfolios. Its 100% equities portfolio displayed strong relative performance during the second quarter. And year to date, it has outperformed the global equities market overall as well by 40 basis points. In terms of the 100% fixed income portfolios, in a similar fashion to the broad fixed income market, it posted slight negative returns. However, it eked out a small gain against the benchmark. And year to date, it has performed in line with the benchmark. So the strongest performer in the equities portfolios fund lineup was the first Sentia FSSA Dividend Advantage Fund, which is an Asian-focused fund. And the Schroder Global Emerging Markets Opportunities Fund also contributed to the performance. As KJ has mentioned, that Asian markets and emerging markets, the equities market actually delivered really strong return in the second quarter. And the fund's exposure to these markets helped to support the performance of the portfolio overall. The fixed income portfolio's performance was primarily the underperformance was primarily due to the Franklin Templeton Western Assets Global Bond Fund. The fund typically runs at a slightly longer duration than the Bloomberg Global Ag Index. And as we have mentioned before as well, the longer duration would have detracted from the relative performance as yields increased over the quarter. And actually last week, we initiated an upgrade to flagship CPF portfolios with the introduction of three-dimensional funds. So if you are invested in the CPF Flagship Portfolios, you would have received an email on the in-app notification on the recommended portfolio change. Please do check it out. And moving on to the factor portfolios. It's 100% equity portfolio, which is the very aggressive one, underperformed its benchmark over the quarter, while the 100% fixed income portfolio, which is the very conservative one, outperformed the global fixed income benchmark by a slight margin. While the equity portfolio's allocation to emerging markets fund contributed to its resilience during the month of April, the fund's exposure to the Pacific Basin Small Companies Fund was the main detractor from relative performance. And the fixed income portfolio's marginal outperformance compared to the fixed income index was helped by its allocation to the shorter duration funds. And just as a reminder, factor premia, which this fund has exposure to, are long-term in nature, and investors that maintain exposure to them over a long-term horizon are generally rewarded. However, this does mean that there may be short-term periods of underperformance from time to time. And next, let's look at the ESG portfolios. So during the second quarter of 2024, they delivered performance in line with expectation, despite the underperformance against its benchmarks. The equity portfolio's underperformance relative to its benchmark was primarily due to its sector allocation. As Kyungju has shown previously, there was meaningful sector performance dispersion in the equities market in the second quarter. The portfolio was overweight in healthcare sector, which underperformed in Q2, and at the same time, it had an underweight allocation to the communication services sector, which was actually one of the best performing sectors in Q2. However, notably, security selection by fund managers within sectors was positive in Q2, which helped to offset some of the underperformance. Its fixed income portfolio also slightly underperformed the benchmark. A negative impact from duration was mostly offset by the positive contribution from credit as spreads continued to tighten. A reminder here that Endowus ESG portfolios not only focus on the financial returns, but also on promoting positive societal and environmental impacts. We are committed to being responsible stewards of capital. And turning over to KJ for income, cash smart, and satellite portfolios.
Thank you, Yulin. So for the income portfolios, across the board, all the three income portfolios are achieving their payment targets. So the stable income portfolio achieved a positive return of 0.3% in Q2 2024, and this was outpacing the broader credit market. The biggest contributor to the outperformance was the portfolio's allocation to flexible bond funds, which invested into markets like emerging market bonds and Asian bonds in the period that did pretty well. The higher income portfolio returned a 0.5% return in Q2, also outperforming the 20% equity and 80% fixed income benchmark. The portfolio's equity portion hurt in Q2, but it was offset by the positive returns from the fixed income sleeve. And this really highlights the importance of diversification. So for the future income portfolio, it delivered a return of 1.5% in Q2, again, outperforming the 40% equity and 60% fixed income benchmark. So both the fixed income and equity components of this portfolio contributed. And as a reminder, the fixed income sleeve of this portfolio mirrors the stable income portfolio, and which did well again thanks to its flexible allocation across various fixed income asset classes. The equity sleeve benefited from Asian equities that made a strong recovery in Q2. Next, the cashmere portfolios. They continue to maintain a stable positive returns in Q2. So firstly, the cashmere secure portfolio delivered a return of 0.95% in Q2. And over the past year, this portfolio has been delivering returns of 0.8 to 0.9% every quarter. And this is really because they are benefiting from the high rate environment. Secondly, the cashmere enhanced portfolio reported a return of 0.96% in Q2. We have observed a good rebound from the underlying funds in May and June because there was an improvement in investor sentiment around the Fed's rate cut this year. And lastly, Cashmere Ultra achieved a 0.92% return, and this was driven by its exposure to things like securitized instruments, as well as the more positive investor sentiment around the fixed income markets. Next, moving on to satellite portfolios. So firstly, the China equity portfolio, it underperformed the benchmark over the quarter, and the portfolio's underlying allocation to consumer staples detracted the most, whereas allocations into information technology and communication services helped the portfolio. From a regional perspective, the portfolio benefited from investments into markets like Taiwan. On the other hand, the portfolio's A-shares allocation continued to hurt because of the weak sentiment in the local markets and a soft domestic market. For the global real estate portfolio, it retracted in the second quarter, generating a return of negative 3.2%. And most of the underperformance continued due to investors expecting fewer and fewer rate cuts in 2024. Third, the Megatrends portfolio, it generated slightly negative returns in the quarter, and this was due to continued pressures in some of its underlying themes, such as clean energy and agriculture. The technology portfolio achieved a 5.4% return in the first quarter, continuing to benefit from the large-cap rally driven by AI developments. And amidst the market rally, the underlying fund managers are adopting a cautious stance because they're aware of the mixed macroeconomic indicators. And this careful investing approach resulted in the slight underperformance of the portfolio relative to the benchmarks, although this careful investment approach did provide better downside protection in April when investor sentiment back then was a bit sour. Moving on to the fixed income portions, the China fixed income portfolio registered positive returns over the quarter, benefiting from the tightening of credit spreads in Asian markets, as well as from the anticipated rate cuts coming from the People's Bank of China. Lastly, the low volatility fixed income portfolio ended the quarter flat and performed in line with its reference benchmarks. Some of its detraction came from its longer duration funds, while allocation to shorter duration funds helped the portfolio. And that's it for portfolio recap. For more details, you can refer to our performance update article that's going to be published soon on our website. Back to you, Yulin.
Thanks, Kyungju. So we will move on to the market outlook section. And we will start with the outlook on rates and credit, and then moving on to the equities market. Next slide. So the ever-changing market narrative on where interest rate is heading can be really confusing and paralyzing to investors' decision-making. I have already seen a few questions on Slido about questions relating to rates. However, I would like to draw everyone's attention to the big picture. I'm quoting PIMCO here. The early 2020s inflation shock and steep policy rate hikes produced a generational reset higher in bond yields. The chart here compares the 2019 and 10-year government yields globally versus just end of last month, end of June 2024 10-year yields, and these are all in the USD hedge terms. So as you can see clearly that yields have come up meaningfully across regions. And a very important point, which is not illustrated by the chart, is that real yields, meaning yields after taking out inflation, after adjusting for inflation, have become positive. What this means is that it should really cheer fixed income investors, as the starting yield supports an attractive long-term outlook for fixed income returns as inflation recedes. And on the next slide, so going forward, it is expected that rates will gradually come down, gradually and eventually come down. However, should investors be worried about near zero rates as we have experienced in the 2010s? Because if that happens again, then it's not great for income-seeking investors. For example, like fixed income is just was not generating enough income. But the chart here hopefully can shed some light for you. It plots the historical Fed rate in solid gray line, so we can see the ups and downs and the recent quite dramatic straight line up. And also it plots the projection of the Fed rate by the Federal Open Market Committees in the dotted blue line, and the projection of the rate by the futures market in the dotted green line. And the dotted lines actually tell us that the forward expectation by both the broader markets and the Fed points to lower rates. However, the market is expecting the Fed rate to reach about 3.73% mid of 2026, which is in 2 years' time, which is far higher than the 2010s level. And the Federal Open Market Committee's long-term projection, as indicated in the purple dot, is at 2.8%. Moving on to the next page, on to credit. There has been increasing concern in the market with regards to tight credit spread. A quick explanation here, what credit spread means, it is the difference in yield between a corporate bond and a treasury bond of the same maturity. So it measures the additional return investors demand by taking on additional credit risk via investing in a corporate bond. And what happened in the last year is that credit spreads for both investment grade and high yield credit have tightened meaningfully. And the chart here plots the historical credit spread for US high yield in pink and US investment grade in brown. And as you can see, they are at historically low levels. And the tighter credit spreads have fueled positive performance in the credit sectors, as we have seen earlier. But of course, it beckons the question on credit sector's future performance. 3 points here. First, tight credit spreads do not equal future negative returns. As we have shown, the overall yield level is really high now. So going forward, returns are most likely coming from the yields for the credit sectors, i.e. income, and not so much from further spread compression, i.e. capital appreciation from the spread compression. And second, investors have to look under the hood. Dispersions remain between sectors and geographies, and pockets of value still exist. Examples of where value might be are agency mortgage-backed securities, European financial credit, for example. It will be really challenging, though, for investors to monitor all the markets and allocate their assets themselves. However, we can rely on active managers to do this for us. And this also leads to my last point, which is on diversification. One can hedge against tight valuation on any given sector by diversifying it with exposure to other sectors that are less correlated. One potentially structural change that has happened after COVID is less synchronized business cycles and lower correlation across different financial markets. So investors should particularly stay diversified in light of this change. If you are heavily concentrated in just the US market, why not consider some emerging markets and European markets exposure, for example? Moving on to Kyungju, who will bring us through some key topics such as small cap US election, etc.
Thanks, Elaine. So moving on to the outlook for equities and US elections. Firstly, I want to start by talking about small cap stocks. And I do see a few relevant questions on Slido as well. So hopefully this slide would answer your questions out there. So small caps, just as an explainer, small caps refer to companies that are not so large in terms of their market capitalization. So these companies are typically smaller, less established companies as compared to larger cap stocks that tend to be major corporations or industry leaders. And as you can see from the chart, small cap stocks went through a pretty bad plunge around March and April of this year. And this was really because many investors were anticipating fewer and fewer rate cuts in 2024. But fast forward to a week ago when we saw a sudden surge in the performance of small cap stocks globally. And again, this was due to more investors starting to think, again, that we might actually see a rate cut this year around Q3, as well as due to the decreasing uncertainty at that time regarding the US election outcomes. Still, this surge was very short lived as the market saw another wave of uncertainties again, and the small cap performance started to correct again. So, the small cap space, although it is still trading at a huge discount compared to large caps, it still remains to be seen whether they can finally catch up given all the uncertainties in the market going on. So, addressing the question that I see on Slido regarding our views and recommendations, given the rotation from large caps to small caps, our view is that it is still too early to tell. As you can see from this chart, all the events that have happened in the past month, past week and so, these asset class is very sensitive and they react very closely to the market data available, whatever that's going on in the market today. So I think it's still very early to tell. And our advice again would be to stay diversified, stay invested in small caps as well as large caps. And I will be talking about this point later on. But again, going back to our presentation, to the next slide. A major talking point in the market now is the US elections. And there has been particularly a lot of development regarding the elections again in the past month. And the market is seen to be making a lot of short term speculations in order to take advantage of the final outcome of the US elections. And I also do see some related questions on Slido. Some of our viewers are asking what our views on the US equity markets or our view on other asset classes given the outcome of the US elections. And here we would like to invite you to take a step back and ask yourselves, is short-term speculations really the most reliable way of investing, or is there a better way to take advantage of the US election outcomes? If you look at the next slide, history suggests that it doesn't really matter who the president is. And here's a related data to illustrate my point, which is that historically, since 1929, there has been no systematic correlation between equity market returns and the party of a president. So it doesn't matter if a president is a Democrat or a Republican, because the market still tends to yield positive returns over the period of a presidency. If you look at the next slide, well, one may then ask, how about investing in an election year versus investing in a non-election year? Well, here's another set of data that suggests that it doesn't really matter when you invest. Because if you look at average returns, election years did tend to produce slightly higher returns. but this also came with higher volatility compared to non-election years. And the average returns are actually pretty similar, which may suggest that there is no point in trying to time when you enter the market based on elections. And what really matters is that you stay invested for the longer term to improve your outcomes. So if you look at the next slide, as shown in this chart, this is the growth of the S&P 500 index from 1920s to last December. And as you can see, diversified equity investments such as the S&P 500 tends to go up in the longer term, and it doesn't matter who the president is. So in conclusion, although there may be certain equity stocks or sectors that can benefit from who becomes the president in the short term, it doesn't matter too much in the longer term because the equity market as a whole tend to reward long-term investors who hold on to their investments regardless of market noise or trying to time the market. And on the next slide, speaking of timing the market, we've also noted a few common inquiries from our clients, which is what do we think about the high equity valuations in the market today? Specifically, some of you have asked us if we should wait until the market goes down a little bit and equity becomes cheaper before investing your money. And here are two charts that can answer this question. On the first chart, you can see the difference between the returns when you invest on a day where the equity market has peaked, and that's in green, and versus when you invest on any other day, and that's in gray. And contrary to common belief, it doesn't really harm you to be a bad market timer and to invest at the market peak. In fact, based on historical data from 1988 to 2023, investing at market peaks actually can lead to favorable returns, especially if you invest over the long term. And another thing to remember is that the market peak refreshes itself very, very frequently. So if you look at the second chart, if you see a market peak and you don't invest because you think the market has really peaked for good, it's likely that you will only miss out on your valuable time in the market because the market will peak again sooner or later. Again, what matters is spending time in the market and not timing the market. Back to you, Yulin.
Thank you, KJ. Just to continue on what KJ has been saying about being long term, I just wanted to show everyone a very interesting chart. And the chart actually plots, it looks very similar to the other charts that we have been showing, a growth of wealth chart of different asset classes. But what is different here is that it has adjusted for the inflation. So what you see here is actually an inflation adjusted chart. That's the real growth of money for the cash equivalents. That's the SIBOR 1 year and the T-bills on the light blue and green lines. And for fixed income and global equities in Sing dollar terms, and also a 50-50 asset allocation portfolio. And I really truly think this is what really matters for the investor in the long term. It matters how much your investment is growing, is outpacing inflation in the long term. And I wonder whether you find anything surprising on the chart. In the long term, cash and cash equivalents, the bottom two lines, they failed to outperform inflation. So the real money growth for T-bills, for example, have been negative in the past 20 years plus. And it's quite ironic that the safest assets became the riskiest assets, if risk is measured by your chance of underperforming inflation in the long term. So many of you might know this already, but I am just reiterating the point here because in the past 2 years, many have fled to fixed deposit and money market funds in the midst of heightened market volatility. It is understandable, and actually you would have done pretty well, I think, but it is time to question whether it is really a wise long-term investment plan. And how would you think about risk in your investments, and can you step up your risk taking so that you can at least beat inflation in the long term? Just flashing one last slide before we move on to Q&A. The next slide, please. Your money, your decisions. So you can choose to spend it, you can choose to save it, but it will be hard to beat inflation. Or the tendency for many people is to speculate, right? To trade, to train your portfolios, to adjust it based on what is going on in the market. But we think that the optimal solution for your money is to invest it, to really look into the future and see what needs you would have, and to invest in portfolios that take some risks that will be compensated in the long term. So that wraps our presentation, and we will go into Q&As. Let's take a look at the questions. Okay, why don't I start, and Kyunju, feel free to jump in as well if you have any ideas to add on. I'll just take top upvoted question first. Do you foresee a steepening of yield curve where short-term rates are lower while US 10-year yields are higher due to deficit spending? I think not just because of deficit spending, which is definitely in the long term inflationary for the US economy, but also because of other reasons, like actually near term inflation is coming down and the economy is still relatively resilient. Um, I actually do see a high chance of curve steepening as we go back to normal, and as the Fed gets closer to cutting rates, and because of all these dynamics that's playing out. So that's my simple response. I think, yeah, whoever is asking this question must be quite well versed in the financial markets.
I can try.
You want to take the second one?
Yeah, the second and the third one. The second question being, what's the progress for Endowus to bring in U.S. equity funds tracking the QQQ or NASDAQ, especially for CPF OA? I guess for now, we've been working very closely with our index fund providers, such as the likes of Amundi or the likes of BlackRock that you see on the flagship portfolios. But so far, we unfortunately do not have a meaningful development or updates to let you know. We'll be sure to come back with more updates if there are more developments in the horizon. But thank you again for your interest in this asset class, and your feedback is duly noted. The third question we see here is about the weekend Crowdstrike incident that caused funds with Microsoft shares to drop prices. How do you see this impact in the near term? Well, firstly, I'd like to highlight that although the stock prices of Crowdstrike, as a direct consequence of what happened over the weekend, over last Friday and so on, could have been mapped to the event itself, I would also highlight that this also sent a wave of downward pressure across the equity market. So it's not just Microsoft, but the broader equity market has seen a downward movement ever since last weekend. So we might think that it might be a bit hasty to make this correlation between the CrowdStrike incident and the Microsoft shares. But regardless, we don't. If we were to make the forecast into how this incident can impact the technology sector and the broader equity market in the medium to short term, we would say we shouldn't hold ourselves back from saying it's gonna be volatile. And it's not just because of this event; it's also due to these many other market events that is happening today out there. But our belief is that over the long term, it will steady out. And unless if you have invested your funds into appropriate goals and appropriate risk appetites to match your goals and needs, our advice that it shouldn't impact you in the short term too much.
Okay, I'll address two questions. One is on which sector will benefit from interest rate cuts. How is Endowus tweaking flagship portfolios for that? I would firstly advise against, I guess, being quite tactical on timing the sector performance based on the prospect of rate cuts, because it might not play out as what we think it to be. Firstly, the market is always pricing in based on the available information, the number of rate cuts that it's expecting, and the kind of the time at what point in time it will happen, right? So we saw how the market expectation has been shifting and that has been changing. The question is, can we do it better than the overall market? And if we can't, it's already been priced in. That's the first point. So don't try to time it. And the second point is, if you really want to, I think we know that generally when the rate comes down, longer duration assets will benefit, keeping everything else constant. Assuming, for example, the economy is still in good shape, etc. Otherwise, for example, if the economy goes into unexpected weakness, then even the longer duration kind of equities assets will actually be hurt because the fundamentals of the companies will be hurt. So that's my second point. And the last point is keeping a strategic exposure to duration risk will be beneficial as the rate comes down. And that is because it will help you to benefit from the current level of high rate. And if the rate comes down, that duration exposure will benefit. It's just mechanical. When the rates come down, you know, the sensitivity is a negative correlation, right? There will be capital appreciation on the duration exposure, but it's very hard to tell how that like credit exposure and equity exposure will be affected because we don't know the economic picture when the rate cut happens. And in terms of our flagship portfolios, we are not tweaking it to benefit from the rate cuts. So our, for example, the fixed income portfolio, the very conservative one, already has a core duration exposure, and that's there to, you know, give the portfolio the cushion when the rate comes down. Then it will benefit from that capital appreciation. And our equities portfolio continues to be globally diversified, which I guess it's more long term and not really tactical in reaction to any short term developments in the market. Kyunju, do you want to take any questions?
Yeah, I'm looking at the question asking the differences between the flagship fund and the CPF fund. Why does the CPF fund before significantly better? I am not too sure if I am interpreting this question correctly, but I am assuming that the viewer is asking why the CPF portfolio before the RPC that we conducted recently is why is the old CPF portfolio better than the new CPF portfolio? And I wanted to address that given I think there are a lot of ways, different ways to answer this question. And I am not too sure of the definition of better portfolio from coming from this viewer, but I like to point that the new CPF portfolio also has several advantages over the previous version, including the fact that the new CPF portfolio now has lower cost, which is the only outcome where we can really control. Lower cost means that higher returns compounded in the longer term, so we see that as a win. The new CPF portfolio, they also have a more balanced equity exposure. And what that means is that the new CPF portfolios allocations into different geographies like Asia, US, Europe, as well as the new portfolios allocations into different sectors like, for example, IT, communications, consumer, and so on. They are much closer to the market benchmark compared to what the allocation has been for the older portfolio. So we see this as a better thing also because the newer portfolio will return performances that are similar to the broader market without having specific geographical or sector tilt. So the performance will be more predictable. So we see it as a win as well. So yeah, I hope that answered the question.
Yeah, maybe I'll just add. I think the CPF fund universe is just fundamentally more limited than the flagship. So for example, the one key difference between our CPF and flagship portfolio is that flagship portfolio consists of more passive and systematic funds that's broadly diversified, whereas the CPF portfolio still has, for example, the two active funds, the dividend advantage fund and the Schroeder fund. So that could basically there could be deviations between the two portfolios at different points in time because of the different styles. But in the long term, I think both are globally diversified. And actually, the RPC that we just did, the portfolio change that we just did for the CPF portfolio, was aimed at bringing it kind of closer to the benchmark, a little bit more passive, more systematic by introducing dimensional funds.
There's also a question regarding the returns of the income portfolio, asking whether the returns are including distributions. Yulin, do you want to take that question?
Yes, the return does include the distribution. I know it might appear that the return seems to be quite muted, but we have to be, I guess, aware of the overall fixed income market and equities market. So if you compare our portfolios with their respective benchmarks, actually they're doing pretty well. For example, on a one-year basis, our stable income portfolio actually outperformed the global credit index by over 1%, and that is pretty remarkable in the fixed income space. I think overall fixed income market just had a really muted performance for the past 1 year because of all the volatility. And then 2022 was also a pretty bad year. It was like one of the worst years for fixed income in the past 30, 40 years. And that will drag down the trading performances. That's why on a 5-year and 3-year basis, you are seeing pretty low numbers. But I think if you look at the portfolios on the forward-looking basis, so for fixed income portfolios, the yield to maturity number has a pretty high correlation with the future return. And because the yield has come up, the yield to maturity for our fixed income, the income portfolios, fixed income components has come up significantly as well and is generally above 5%. So I hope that offers you some comfort and clarification.
Yeah, I'd also like to remind the viewers that if you want to compare the annual payouts of the income portfolio, it might make more sense to compare those payouts to the returns, to the 1-year return of each portfolio. And you will find that the returns are actually pretty similar levels as the 1-year payout of the portfolios.
Yeah, the question on market view and recommendations on large cap versus small cap, Kyungju has already covered it, I believe, during the webinar. So yeah, basically our view is that it will be very hard to time the rotation, and the best thing is to actually have exposure to both. And hopefully that answers your question. And also on the election as well, we actually have written articles on kind of the impact of election on the markets, and we do this every 4 years whenever there's an election coming up. But basically, there's really no correlation between the market's overall performance and the election results. There will be probably a bit more volatility because of the political uncertainty, but yeah, it is advisable to not focus too much on the short-term volatility and just ride it out.
Well, I think we're coming closer to the hour, and I'm just scrolling the question list just to make sure that we have addressed all of them, and it appears to be so for the time being.
Yeah, maybe I'll take one last question before we end. When is a good time to invest in the Endowus Flagship Bond portfolio now that interest rate has peaked? Well, if you are of the view that interest rate has peaked, then it is, I will say, a good time now to actually consider adding fixed income exposure, so that you can enjoy the high yield now and won't regret when the yield has come down. Yeah, hope that addresses most of the questions, and we will follow up with you on other questions. So we will still be answering the Slido questions, if any. So you can check it out, and if you have any questions that you want to ask us, you can always write into cx@endowus.com, and our client experience team will be there to address your questions. So that's it. Thanks for joining us today. Really appreciate your time and wish you a good rest of the day ahead.